Every time you open the news, it feels like a crash is coming. Interest rates, trade wars, tech layoffs, it's a perfect storm. But is it panic or prediction? Hey, I'm Robert and this is The Alternative Investor. Let's get one thing straight, not every dip is a crash, but every crash starts with warning signs. Today we're going to walk through what's happening under the hood of the market right now. I'll share the red flags, the data Wall Street is quietly watching, and how you can prepare whether the market collapses or rebounds. Right now, volatility is up across all major indices, and it's not just noise. Since the US announced sweeping new tariffs in early April, we've seen 3 back-to-back sessions where the Dow dropped over 500 points. That kind of downward momentum isn't just technical, it's psychological. Investors are nervous, and they're reacting faster than usual to headlines. These tariffs are hitting everything from industrials to electronics, and they're disrupting global supply chains. The S&P 500 is flirting with key support levels, and the VIX, Wall Street's fear gauge, has surged over 25% in the last month. Bottom line, volatility like this doesn't mean a crash is coming tomorrow, but it does mean institutional investors are repositioning defensively, and that should grab your attention. One of the clearest leading indicators of a slowdown is how consumers feel about the economy, and in 2025, that's turning bearish. The University of Michigan's most recent Consumer Sentiment Index dropped to its lowest level in 4 years. Why does this matter? Because consumer spending drives about 70% of US GDP. When consumers feel uncertain, they pull back, and that slows down earnings for everything from big box stores to tech platforms. We're also seeing the effects in retail stock performance, where discretionary companies like Nike, Target, and even Amazon are showing relative weakness. Hedge funds have reportedly reduced exposure to consumer cyclicals, shifting instead into gold and defensive names, according to recent Goldman Sachs trading flow data. The writing is on the wall. When Main Street pulls back, Wall Street feels it next. Some experts, including Senator Elizabeth Warren, have already warned that interfering with the Fed could trigger a massive stock market crash. This isn't just political noise. This is structural risk, built right into the leadership dynamic of the world's largest economy. In its latest April outlook, the International Monetary Fund revised down global GDP growth projections, citing accelerating deglobalization, heightened trade friction, and political instability as key concerns. For the US, GDP forecasts for the second and third quarters have been cut by nearly a full percentage point, driven by expectations of softer consumer spending and reduced capital investment. Globally, Europe continues to flirt with stagnation, and China's post-COVID recovery has lost steam. Supply chain disruptions and energy volatility haven't gone away, they've just shifted regions. We are no longer in a synchronized recovery, we're in a fragmented slowdown, and historically when global growth slows while US rates remain elevated, equity markets struggle to justify high valuations. If a crash happens, or even if we enter a prolonged correction, the investors who do well are the ones who act early and think strategically. Here's what you can do now. Rotate into defensive sectors. Healthcare, consumer staples, and utilities historically outperform during downturns. These companies offer consistent earnings and are less sensitive to consumer moods. Build cash reserves. Cash isn't trash in a crisis. It gives you dry powder to buy when prices drop and acts as psychological insulation when everyone else is panicking. Add exposure to gold or short-duration treasuries. These are classic hedges that protect capital and preserve purchasing power. Use options for income or protection. Selling covered calls on your long positions or buying put options on overvalued indexes is a way to make volatility work for you. Diversify globally and across asset classes. Don't just think US stocks. Look at international funds, commodity ETFs, or even REITs that generate stable income. Preparation isn't fear, it's leverage. So, are we headed for a stock market crash? The answer isn't black and white, but the conditions are aligning: spiking volatility, weak consumer sentiment, rising political instability, and slowing global growth all increase the probability of a market correction or worse. This is the time to get strategic. Tighten your portfolio, focus on quality, and prepare for opportunity, because the investors who win in downturns are the ones who saw it coming and didn't flinch. I'm Robert, and this is The Alternative Investor. If this gave you clarity, hit like and subscribe and let me know in the comments, are you prepping for a crash or buying the dip? Let's talk.